Hi, welcome back to the Invest in Value channel. I'm Victor, and today I'm going to talk about how inflation-protected bonds are outperforming the S&P and will likely outperform the S&P in 2022. Before I jump into my analysis, do me a big favor and like my video. Also consider subscribing to my channel, and last is hit that bell notification so that you know when I release new videos. Now let's talk about inflation-protected bonds and how they're outperforming the S&P. So the S&P this year is not doing so hot. Today I had a really bad day. Today's April 5th, 2022, and it was down 1.26%. For the year, it's down more than 5%, I believe, 5.66%. So it's been a very volatile year. Just yesterday, the 4th of April, the market was up, the S&P was up, not quite to 1%, but it was up, and now it's down. So it's going to be a very volatile year. All kidding aside, I've been getting out of positions really beginning toward the end of 2021. Had a great run from the COVID period through probably about October of 2021. And I started exiting positions looking for diversification because I don't believe the market's going to continue its appreciation graph. It's just it just seems impossible for that to continue. We also have a lot of negative news out there. Interest rates have gone up. Interest rates have just eclipsed, like on a mortgage rate, has eclipsed 5%. The Fed has to control inflation. They're really committed to controlling inflation, even if they need to take our economy into a recession. They're hoping they have a soft landing, but chances are we're going to end up in a recession. So those things really caused me to think about, okay, how could I beat the S&P this year? It's going to be hard to do it with stocks. I can definitely do it with stocks, but why not look outside of stocks where I can kind of gain an advantage? And I think the inflation protected bond may be that advantage I'm looking for. So let's talk about I bonds first. The I bond is sold from the Treasury directly. And I have a different video on my channel where you can get more information on where you would go to treasurydirect.gov and you can buy I bonds. I believe the minimum investment is $25. Maximum investment per individual is $10,000. And you can get information there, no fees involved. You do business directly with the federal government. And this I bond is a risk-free bond. So I kind of put it on this line here, the risk-free I bond. It's pretty much, if you buy $1,000 bond, it's worth $1,000 when you cash it in, when you say, hey, I want my $1,000 back. Unlike a stock, if you buy, 5 shares of, let's say, PayPal today, you show up in a year, it may be worth more or less. And, judging for where the market's at, it may be significantly less. But that I bond, it's very stable. It's going to be there. The difference or how an I bond rewards you is it gives you a yield. And these are inflation protected bonds that the government produces, and they're pegged on the inflation rate. And inflation's so high that it provides a great yield of 7.12%. So let me do some quick, analysis here. So currently, the S&P is down 5.66%, and the yield on the S&P is only 1.27%. That's the average yield on S&P stocks, the ones that do pay a dividend. And my source there is Y Charts. And if you compare these two yields, the I bond has a 5.85% yield advantage, just right off the bat. If the two investments stayed at the same levels as today, you'd be 5.85% ahead of the S&P. But it could be even more, because currently, if you had bought I bonds at the very beginning of the year, at every point this year, you would have outperformed the S&P just on appreciation or devaluation, comparisons. And if the S&P continues to go down, in value, you're going to have an even greater advantage against the S&P. Think about, like, at the lowest point of the S&P, it was down more than 12%. It was in correction territory. At that point, if you had invested in I bonds, you would have been almost 18% ahead of the S&P, which is awesome. So that's an I bond bought directly from the Treasury Department. Now I'm going to talk about a particular mutual fund of inflation-protected bonds sold by Fidelity. The ticker symbol is FIPDX. This fund it behaves a little different than just a pure I bond, but similar. I put that in the kind of a lighter blue line here. This is the Fidelity Inflation Protected Bond Fund. And you can see that almost at every point this year, it has been outperforming the S&P as well. This is easy to get into, easy to get out of. You can buy these with your brokerage account. You can buy this with your 401k, I believe. You should be able to get in and out of this one fairly easy. I own both the I bonds and I own this fund. The I bonds, by the way, there's a limit of $10,000 that you can buy. So you hit an individual limit. Married couple can have 20,000 since there's two individuals in that marriage. But again, there's a differential in dividend yields between this fund and the S&P yield, the average yield of the S&P. The yield difference being the FIPDX has a yield of 4.81%, and the S&P average yield is 1.27%. So you have a yield differential, yield advantage of 3.54%. So at any point, like if the two investments devalue or appreciate at the same rate, the Fidelity inflation protected bond wins because it has a greater yield, 3.5%. But as you can see, when the S&P goes down, this fund goes up. So it's kind of a contrarian fund against the S&P. And again, we've got a lot of negative news out there. And this negative news is not going to go away in a couple of weeks. The whole inflation issue, taming this inflation may take 2 years. Interest rates, have risen, so it's going to cause shocks in the real estate market, and that's going to create shocks in other industries. So I think we're in for some stormy weather in 2022, and that's why I'm looking at alternatives to stocks, just to take some of my gains off the table and protect them. And really, in doing so, I'll be outperforming the S&P. So my plan, for 2022 is to sell my weaker stock positions, the ones that have, the least intrinsic value discount. If you watched any of my stock evaluation videos, you could see what that means. And then take those funds and buy into bonds each month. I want to build up a position. I'd like, from my stock fund, maybe take about 10% of that fund and move it into bonds. I'm going to continue, the best investment I can make in bonds or stocks is education, studying companies, studying bonds, studying the market, and getting as familiar and knowledgeable as I can. And I'm going to do that. Bonds is one of the topics that I research as much as I can so that I can stay on top of that and uncover opportunities so I can outperform the market. So just keep in mind that this video is for entertainment purposes only. I record these videos to share my experience with investments like this, and it is not any recommendation for you to buy a particular stock or bond or any type of security. Please weigh your investment decisions, heavily, and consult a professional if you feel like you need one. With that, I want to thank you for watching my video. Please provide any comments on my video. Would greatly appreciate your feedback to either learn something or improve my videos. Please hit that like button on my video. I'd really appreciate that. Consider subscribing to my channel and hit that bell for notifications on future videos. With that, I want to wish you the very best of luck in investing in 2022, and I'll see you on the next video.